markets. Mayuresh Joshi is also again now joining us. Mayuresh, good morning. Welcome to the show. First up, now give me your view around 11,000 perhaps. Does this give you enough reasons to actually add long positions, or you want to actually book profits, or you want to stay cautious?
So morning Piyush, I think staying cautious probably would be the right strategy at this point of time, because the entire move on the markets is probably happening in terms of expectations at this point of time, and the market is actually ignoring a whole host of factors. So what you probably expected to see through these Trump tariff measures and how China is reactivating at this point of time. Again, I think what happens with central bank raising rates and our own data points. So I think the expectations even for today's CPI number is going to be on the higher side. And couple that up with crude. Though you've seen a fall happen in yesterday night's trade, I think the expectation or the general consensus of Brent staying between 70 and 80 and the rupee depreciating also has that additional onus in terms of our fisc and the current account stability. So I think earnings momentum and earnings stability and earnings recovery, I think these three factors are going to be extremely critical for the markets. The flows have held out to be pretty strong so far, though you've seen a marginal dip on a month-on-month basis. I think the domestic flows are lending support to the markets at this point of time. So I'll be adopting a stock-specific approach in these markets, because valuations, in my opinion, are probably at the higher end of the range in the absence of earnings not yet getting delivered.
Mayuresh, in that case, what stocks would you be looking to buy in this market then?
Morning, Samina. So I think it's a large element in terms of having a skew towards large caps and good qualitative mid caps. The themes that we probably like within this market over the next 1.5 to 2 years, looking at earnings growth and earnings visibility. I think auto stocks, auto ancillary stocks specifically look reasonably poised to capture these opportunities. Consumption is a huge basket. So I think within consumption, selective FMCG names, consumer durable names, you've got select paint companies which have actually done very, very well. You've got a certain amount of companies within the overall basket on the infrastructure side that can be expected to do well. So I think the government push through and rural spending expected to come back, which can get reflected in the second half, is clearly going to propel volume-led leverage growth on a lot of these balance sheets. So selectively, I think these sectors look good. I think stocks within IT, pharma have moved up significantly. But I think the value migration in terms of earnings potential actually getting delivered after the second half and over the next few years can be quite reasonable. So I think selective stocks within this space also probably look good.
If you're growing at a 60% speed, valuations really take a backseat.
No, so obviously I think, valuations are equally critical and pertinent to be observed when you're probably looking at a long-term growth story. So though the earnings trajectory will improve going forward and it will largely be volume-led, I think what a lot of these FMCG companies, consumer staple companies are doing is that with volume growth they're probably having the realizations up as well. For two hot reasons. A, I think the input cost inflation obviously has taken a hit, so I think natural price hikes were required and mandated. But to a certain extent, as demand starts coming back, the realization pass-through happens far more efficiently, and because of that, the cash flows improve. Because the cash flows improve and the margin improvement is very, very evident, I think this money again is reinvested into brands, driving volume growth again. So I think this is a cyclical story that will get played out. And you're right, I think the consumption patterns will improve. They will improve very, very gradually, and consumption is broadly based urban and rural. So at this point of time, I think within the FMCG universe, significant growth can still come through over the next few years. Imami probably remains one of our top draws in terms of the moat that it has created around its brand. And from a valuation perspective, I think at least a little bit better than the others at this juncture. But yes, I think extending this theory to autos, two-wheelers, maybe stocks like Hero MotoCorp on declines, auto ancillary stocks, you're probably going to see that in the limelight as well. Lead has corrected significantly because of the trade war fears, and stocks like Exide, Amara Raja can also have a significant amount of margin stability and improvement if lead prices stay this way, along with improvement obviously in its core business, with volumes both from OEM, the replacement market, as well as their industrial segment, specifically the telecom sector.
Mayuresh, would you buy aviation?
So the large elements, obviously depends upon crude, and the sensitivity to earnings depends on crude and the rupee movement. So in that respect, any fall that you probably see for crude oil prices obviously brings a spurt in stock prices. But a large element in terms of a lot of the reported numbers actually coming in rupee terms converted through the dollar route. I think any depreciation obviously takes a huge hit in terms of how they account for their expenses. Again, going by a general assumption of crude staying between $70 and $80 a barrel, I think the kind of expected hit that they've probably taken in terms of their earnings getting downgraded because of this large factor having significant say in terms of their input costs, almost 35 to 40% is ATF costs for aviation companies. And the other element obviously is their realization growth as well. So I think competition is probably hotting up in this sector at this point of time. So the number of players are far lesser. What you probably assumed in terms of the revenue per available seat kilometer, I think that will show gradual improvement. The cost per available seat kilometer, as I said, largely is dependent in terms of crude movement. But ex-crude, the CASK actually looks quite reasonable in terms of the optimization plans done. So the EBITDA margins have probably held out, and the stock corrections have probably embedded a lot in terms of what can go wrong in terms of crude actually moving a lot more higher from the current level. So I think I'll remain specific within the sector. SpiceJet probably remains one of my top picks.
Right, that is on aviation. Mayuresh, let me just also ask you, are markets missing out on the cement and infra opportunity? I mean, we've spoken about the euphoria in private banks, in consumption, in autos, in tech, also the pickup in pharma. But cement mostly languishing near about 52-week lows, barring those sporadic bounce backs that we see here. Is that the next opportunity that the markets may be ignoring right now?
So Dipanshu, again, I think as a sector, I think we remain extremely positive over the next 2 to 3 years. I think the basic premise here is in terms of the capacity utilization levels for the sector as a whole staying between 70-75 and marginal additions probably happening over the next 2 years. I think as demand catch-up happens, and as Sunil was mentioning as well, I think a lot of push-through has already started happening in terms of government spending on infrastructure, government spending on both urban and rural housing. And that definitely abets the volume growth that one really looks at. And with volume growth obviously comes the realization growth. With realization growth and volume growth coming through, the utilization levels for these cement companies start moving up significantly, which gives you the necessary leverage on their balance sheet. Having said that, I think on a quarter-on-quarter basis, obviously you've seen and you will see the impact of higher coking coal prices, even higher crude prices, which is basically getting passed through higher diesel costs. So the freight costs are also going to be higher, which will take a toll in terms of the EBITDA per ton, because the ability to pass through at this point of time has been very marginal, albeit not to say the issues related to sand mining and what has probably happened in terms of the volume growth pickup demand. So I think the optics should be quite reasonable. Cement companies are probably poised to report a reasonable amount of volume growth over the next few quarters and years. At a 1.5 multiplier to the GDP, I think a 10-12% volume growth over the next 2.5 years not ruled out. So I think within the large caps, I think Ultratech is something that I still prefer. It's a clear hold from my side. Within the mid-cap universe, I think stocks like JK Cement, JK Lakshmi Cement look very interesting, both from a volume growth perspective as the earnings, as well as the earnings trajectory, which will probably drive the EVP ton on a couple of years forward rolling basis.
Sun Pharma, there are some legal issues as well that emerged this morning. Glenmark has seen a big revival from this space. Biocon has been very active as well. How are you placing your bets here?
No, so a large element, Dipanshu, in terms of everything that plagued the sector, right from pricing pressures to FDA concerns, the higher compliance and the regulatory cost related to probably resolving the FDA concerns have all probably played out both on the EBITDA margins as well as substantially earnings downgrades which have probably taken place. Now the last few quarters and the last few weeks, the sudden euphoria that has started coming through for the sector as a whole, with a lot of resolutions being seen on the FD affected plants. You're probably looking at a slew of launches coming through, and specifically for a whole host of pharma players. I think the specialty and the niche launch pipeline that they probably possess, I think the pricing can probably come back. So I think the elevated R&D expenses along with higher compliance costs, which took a toll on the EBITDA margins, the street is of the opinion and of the belief that they might have hit the bottom in terms of reported margins, and there can be gradual improvement going forward. Having said that, and from management commentaries of various pharma companies, I think companies having a very strong pipeline within the US market can do well, though I think the outside risk still remains in terms of what Trump can probably do in respect of having this pricing actually getting curtailed. So to that bit, I think we are probably having a very specific approach within the sector as well. Obviously, Lupinsan is something that we've liked in the past, but the stock movement has been quite humongous over the past few weeks and months. So I think the whole recommendations there continue with expectations clearly in recovery in the second half, with earnings still expected to be weak, at least for this quarter and the next. But a large element of what we probably like is Aurobindo Pharma, based on its injectable business, which is high margin and expected to drive the overall earnings trajectory to its acquisitions of Actavis and Natrol. And again, Ipca Labs is something that I've liked in the past over the last quarter or two. I think the stock has moved up quite significantly as well. But our own expectations with their domestic formulations business being the cash cow and doing well, and the tender business actually starting to pick up, along with expectations of their US FDA affected plants, 3 of them probably getting resolved, can give an upside risk to the stock even from the current level. So I think the earnings upgrades are possible, but Ipca probably looks very, very strong because of its domestic formulations.
Right, so fundamentals and technicals falling in place for the pharma space, and a couple of mid-cap pharma ideas also that you can look at apart from the large cap names that are doing well. Himen, Jay, Mayuresh, thanks so much for joining in this morning on a day when the Nifty is back above the 11,000 mark and the Sensex has hit a fresh record high.